The open, high, low, and close prices, taken directly from the first candle on the first day of trading, along with the 20 and 16.20 levels from the first down and upswings. All-time lows are nearly reached, but the transition into 2019 keeps a neutral to bullish tone, as constant contact with the 1555 to 1544 region is maintained. In the broader context, this was the head within an inverse head and shoulders. A mostly clear triple top forms into March, following the volatile peak in late February. Now attention is focused on whether the downtrend progresses or reverses at the 23 boundary. For most of April, short-term context may have seemed neutral, especially as volume was well below normal levels. However, a clear decline was quite visible even before the definitive bearish spike under 23 to finish April and end the descending triangle. Even if this triangle wasn't identified during its formation, the 23 level was already a significant level. As with other examples, the downtrend line has two variations to encompass the approximate downtrend trajectory and remain flexible in the case of volatility. The lower trend line tends towards the real bodies of candles, while the upper trend line tends towards the highs of bearish reversal candles. In this case, fairly weak but largely consistent bullish price action from the small double bottom in October carries over the lower downtrend line, while the upper trend line offered solid resistance, made even stronger by the intersection with the 18 range. In early November, it was surpassed and became key support after a volatile gap up was swiftly filled. It was then followed by the continuation of bullish sentiment to begin a tenuous consolidation over the 18 range. Here is another example where a small double bottom is part of a large reverse head and shoulders formation. The uptrend lines derived from these patterns will be helpful guides in assessing the uptrend that is making solid progress in establishing over the old 23 level. It was a mostly ideal reverse head and shoulders with clear swing points and increasing bullish volume with strong price action to steadily clear the neckline region. A drastic drop in bullish volume and a rapid surge in bearish volume accompanies short-term bearish context, in the form of a double top comprised of a bearish engulfing and a bearish star. As expected, the broader bullish context summarized by the uptrend line becomes a crucial feature outlining the return of bullish sentiment and the longevity of the inverse head and shoulders reversal. It is normal to see a sharp downtrend after the break of the long-term uptrend line. However, it is less common to see the trend line be part of a heavily inclined head and shoulders formation with a sharp head and relatively flat shoulders. Volatility contributes to this pattern being less precise in terms of the formation of neat horizontal ranges. As would be expected, even the rapid drop finds considerable opposition from the great support potential offered by the IPO range. Additional bullish advantage comes from this also being the site of the reverse head and shoulders range. The more recent flat bottom in the IPO range now becomes the gap fill region for the mid-January gap up. a perfect gap fill with strong bullish volume and price action, leading to a swift bullish reversal. Along the way, there is expected resistance approaching 23 due to its previous significance and the small gap down from August. This approximate area also sees the strong rejection of a head and shoulders reversal, as solid bullish volume propels a minor downswing away from the potential neckline centering around 23. In this case, the avoidance of a small head and shoulders was followed by the formation of a large head and shoulders just a few weeks later. Interestingly, this head and shoulders comprises several small patterns in addition to the variation of 2 pairs of downswings for the shoulders. These patterns include a sharp double top head accelerated by a gap down, then a resting phase in a bearish continuation prior to the late 2020 gap down that finished the head and shoulders pattern. This was also more difficult to identify in October and November due to the slanted neckline that extended from the 23 area to the downslope of the descending trend line. Even if the head and shoulders reversal was only identified after its formation, it and the large gap down provide clear long-term resistance to a later recovery. Aside from the IPO range, the 23 level stands out as a contentious and influential range. So it is not surprising it was the site of repeated patterns including gap up and gap down ranges.